Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. I have a very fun one for you today. I'm going to be doing something quite ambitious. I know a lot of people have asked me about telling you my own personal story. Where did I come from? And why I decided to talk about Bitcoin with relentless fervor every single day. We all find Bitcoin at a very specific time in our lives, often on a need-to-know basis, but you really start to understand it, you really grasp it at a more opportune time, when you realize that your total well-being is dependent on it. So I want to talk about the great risk-inversion thesis about how risk is mispriced globally, how that related to my personal situation, and hopefully by going into this stuff in detail, you can kind of start to see how profound of an effect Bitcoin is going to have on society in the next 10 years. We are seriously on the precipice, on the cutting edge of a capital markets transformation, and I cannot be more excited to get into this. So please like this video, help the algorithm, subscribe to the channel to help me spread the orange gospel, and also another thank you to Horizon for sponsoring this video. Horizon helps you buy Bitcoin using your home equity without debt, monthly payments, or term limits. The Bitcoin is fully yours to custody however you want to custody it, with no risk of forced liquidation. They're linked down in the video description. I'll talk more about them at the end of the video. Before you get my personal story and how all these revelations made me hand in my keys to my job and go all in on orange pill evangelism, I want to lay out some first principles, so here we go. I want to deconstruct risk into its three primal vectors: dilution, counterparty risk, and physical fragility. I call this the tri-vector risk map. Number one is dilution risk. Every share buyback in a company that can be reversed with tomorrow's stock issuance, every currency whose supply curve is a political decision, it bleeds the saver. Apple can print shares, the Fed can print dollars, your purchasing power becomes collateral damage. We all know that Bitcoin's supply is pre-agreed, it's auditable and unnegotiable entirely. Number two is counterparty risk. A single transaction at a grocery store touches acquirers, issuing banks, card networks, settlement rails, which is 5 hops, so 5 failure points, and days of float risk. Bitcoin collapses that entire 5-step daisy chain into a 10-minute finality window with 0 intermediaries and 0 reversals. And then along with those two is physical fragility. Factories burn, unions go on strike, regulators pivot, tornadoes do not read 10K statements. Every single physical asset in the world decays because of entropy. Entropy never issues refunds. Bitcoin lives in the digital information space, secured by global hash power, immune to warehouse fires and supply chain paralysis. Now remember, a lot of Wall Street and the general institutions in society, a lot of them call Bitcoin speculative, while assigning blue chip credit ratings to companies that are skating on razor-thin margins and combustible assets. They are weighing risk on one axis and ignoring 2 others entirely. By the end of this talk, those blind spots will be very glaring, and this is what happens when you view the world through a Bitcoin lens. And once you cross the Rubicon, you can really never go back, because the risk map that you're looking at will feel very obvious. We have a world that is drunk on mispriced risk. Think of a global bond market the size of $300 trillion. That is a lot of money, yet a huge slice of that mountain now yields less than inflation. And that's just the CPI inflation, not the real rate of monetary debasement through the money supply expanding. And that is what we call the negative real yield vortex. You are not actually yielding any purchasing power, you are in the red. When that safe paper promises you to actually lose your purchasing power, capital stampedes up the risk curve just to break even. Pension funds and insurance companies are mandated to hit nominal targets, and they become forced buyers of anything out there with a pulse. Now, if you look at this left headline right here, Tesla's price-to-earnings ratio kissed 941x in Q4 of 2020. So what does that mean? That goes beyond optimism. That is an entire generation of yield-starved money betting 50 years of profits up front when they make the trade initially. That is a hallucinatory multiple disguised as growth, and the irony is that every factory, every lithium supply contract, every labor negotiation that is baked into that Tesla valuation, it sits squarely in the physical fragility risk bucket that I just covered a minute ago. One wildfire in Nevada or regulatory swing in Beijing and 50 years of prepaid profits evaporate in one earnings call. So this is the big picture. When fixed income totally deserts you, the market rebrands volatility as value. Investors seek duration in equity, but they forget duration in entropy. They've swapped coupon risk for cobalt mine shutdown risk, and then they call it tech. In a few slides, I'm going to quantify how that stampede misprices everything from Apple buybacks to BBB rated mall real estate investment trusts. But remember this for now, the negative real yields are the mother virus, and price to earnings hallucinations are the fever, and Bitcoin is the antibody to it all because the yield isn't printed, it's programmed, and its collateral doesn't rust, unionize, or litigate. So keep that frame in mind as I continue to dive deeper. Now let's strip risk down to its molecular structure. Finance textbooks zoom in on something called volatility, which are the price wiggles in your Bloomberg terminal. But this is a point I want to make, is that price action is literally just a symptom, not the disease. The real pathogens live in these three rows right here. Row 1 is dilution. We just talked about conventional equity can be a leaky bucket. Central banks can print more currency the moment that deficits hit the ceiling. Your slice of the pie then shrinks while the PE multiple yawns wider to hide the dilution. Bitcoin is hard capped. There's 21 million units. It's auditable and it's non-negotiable. So a Bitcoin-backed preferred share inherits that scarcity. Think Strife and Strike and Stretch from Strategy. Row 2 is counterparty. Every stock certificate that you own is literally just an IOU that swirls through brokers, clearinghouses, custodians, and transfer agents. This is a 5-step daisy chain where any weak link can freeze your capital. Just ask the GameStop crowd what T+2 settlement feels like. Do you remember when Robinhood shut off your ability to buy or sell shares? I do. Bitcoin collapses that chain into a single public key handshake that's settled in 10 minutes. And a strategy preferred piggybacks on that finality. Its collateral can liquidate globally before a bond trustee can ever find a loan agreement. Row 3 is then physical fragility. Remember, factories rust, the warehouses burn, and regulators will rewrite rule books between election cycles, and of course, a pandemic can turn just in time into nowhere in sight. Bitcoin, though, is pure information reinforced by thermodynamic security. It lives in cyberspace, so to kill it, you'd need to turn off the sun. So notice this footnote that I have right here. Traditional finance frets over this first row, but it totally ignores rows 2 and 3 when it comes to counterparty risk or physical fragility risk. And this blind spot is why markets label Bitcoin speculative while pricing fragile, dilution-prone capital equities like AAA annuities. So the takeaway, when you own Bitcoin outright or a security that is collateralized by it, you have opted out of all these three meta risks simultaneously. That's not volatility, that is de-risking from structural risk that is embedded in the Wall Street legacy finance system. And this is where the risk hierarchy flips upside down once we measure what actually matters. So if we look at the share dilution 10% CAGR, the median S&P company quietly grows its share count about 2.4% per year, which is an invisible tax on every long-term holder. BBB rated corporations can't even pretend to hold the line when covenants tighten. They issue on market upswings and prey on the down. Strategies preferreds are zero dilution in Bitcoin terms. The Bitcoin per share always goes up when Michael Saylor issues more equity. Bitcoin itself is obviously absolutely zero. Scarcity is not a marketing slogan. It's literally the structural moat. Number 2 is the counterparty stack. Remember, picture the number of hands that your asset must pass through before that you truly own it. The S&P sits on that 5-hop daisy chain. A BBB corporate bond might trim it to 3, but you still have trustee and paying agent nodes that can freeze you mid-coupon. Coin is 0 hops, broadcast, confirm, and then done. And step 3 is physical loss potential. Equities, remember, they rely on their physical infrastructure, the factories, the fleets, the warehouses. Bonds rely on physical collateral that they post, plus any legal enforcement. Fires, strikes, floods, they all can nuke your recovery value. Strategies coin stack lives in multi-sig cold storage, and Bitcoin itself lives in cyberspace that is backed by the thermodynamic security. So I want you guys to notice the inversion that is happening here by these three vectors: dilution, counterparty, and physical fragility. The instrument that Wall Street calls speculative scores best in class on all of these three criteria, while the assets that the credit rating agencies give investment grade are actually drowning in hidden risk premiums. We talked a little bit about the $300 trillion negative real yield abyss, but I want you to finger the $300 trillion right now. That is the size of the global fixed income outstanding. We went over this, that none of it really yields more than CPI. So when that happens, capital is forced into growth stories that are regardless of underlying fragility. Then we finger the 33%, the index tracking mandates. So think ETFs, pensions, target date funds. They now own a full third of America's entire equity float. So what does that mean, guys? These vehicles, they don't decide to buy, they must buy whenever money hits a 401k. Valuation agnostic, quality agnostic of the investment. If it's in the index, the robot then bids. And then because of that, there is zero incremental price discovery left once 1/3 of every traded share is absorbed by passive flows and another chunk is absorbed by buybacks. The marginal price is being set by mechanical orders that don't care whether a company makes microchips or microwave dinners. This is another big picture. I want you to combine these three facts and you get a self-reinforcing doom loop, starting with step one. Number one, bonds promise negative real returns, which leads to capital stampeding into equities because they have that yield desperation. And then the passive vehicles hoover up those equities with zero due diligence, and then the true price signals in the market disappear because it's all hidden. So fragility in the investment, it just masquerades as growth. And then the loop just resets at a higher multiple. This is how you wake up to 940x earnings valuations on businesses with cobalt supply risk and Shanghai export exposure, all calling Bitcoin too volatile. The abyss that we're looking into is not a macro trivia fact. It's the gravitational field that misprices risk across every other slide that I'm going to go over. If you put the steel and the silicon on the scales, we know that traditional assets, they just decay. Physical risk is an entropy ticking time bomb, and Bitcoin exits that entirely. Every physical asset that you can possibly own is literally just a treadmill that continues to speed up. You pay continuously to then just keep the thing from sliding backwards on the depreciation schedule. Accountants call that maintenance capex, but I call it the entropy tax. In capital markets, in the traditional kind of way of thinking, we obsess over discounted cash flows while ignoring discounted entropy. Bitcoin's maintenance cost is effectively zero at the holder level. The ledger keeps itself honest. Traditional assets require perpetual fiat inflows just to tread water with the debasement of the monetary system. Now, before I was the Bitcoin wizard, I was literally a grocery store firefighter in the retail industry. I know, not the most glamorous job. The situation was I was 17 years old when I graduated high school. I grew up in a town called Marshalltown, Iowa, about 25,000 people, kind of small, kind of not. I didn't really know what I wanted to do for a living, and there was a community college in my hometown, so I went there for 2 years while trying to think of what I could do. I was a very gifted student, but I did not care in high school. I literally ceased to care because I was not stimulated. I wasn't challenged. I know, excuses, but that is reality. I'm not lying. So I didn't have a full ride scholarship anywhere, and I went to college for 2 years and still really didn't know what I wanted to study, knowing that I would have to take out an incredible amount of loans to go to school. I came from a poor family. I didn't have money. My parents could not pay for my tuition. Absolutely not. I had zero of that. I moved out pretty immediately after I turned 18, never received a cent from either of my parents. I was the oldest of 7 kids, so my parents didn't have any money anyway. And I literally just got kind of trapped in retail, and I was good at it. I got promoted about once a year for 10 straight years. First, I started off in Hy-Vee grocery stores in high school. Yes, I was a retail courtesy clerk making minimum wage. That was my high school job, and I stuck with it. Eventually, I became an assistant manager at a Hy-Vee store as they were opening up in the Twin Cities. I then managed 4 different Hy-Vee grocery stores in a variety of roles, really doing grand openings where the company company would build a $40 million store, and then they would hand you the keys to the building and say, hey, now make us some money. And it was a really wild time about 10 years ago in the Twin Cities because we were opening up all of these stores, competing in a very intensely competitive industry, competing against Walmart, Lunds & Byerly's, Cub Foods, Amazon, you name it. And there wasn't like any big training structure from the top down. So really, I was in charge of profit and loss, delivering actual profit to the company. Now, anybody that knows anything knows that retail is a pennies on the dollar business. The profit margins are razor thin. I was fighting entropy unlike you would believe, the things that would totally be out of my control. Crazy. And you think of the investment of just opening up a retail store. You spend $40 million building it, and then you're making net profit of the single digits. On top of that, it is literally decades before that you pay off that investment, assuming that you make money in the first place. I don't want to give out anything too specific, but there's quarters where you will just lose $400,000. You will be negative in the red $400,000 of net profit. It is a brutal, cutthroat industry and very difficult, and your workforce are a bunch of snot-nosed teenage brats, which is fine. Maybe that was a reason why I quit, because I really just did not like dealing with people to that degree. Anyway, every single 20 basis points takes heroic effort because so many things just happen that you have zero control over. The power goes down and you lose $50,000 worth of frozen product. You're putting together 700 boxes of Thanksgiving dinners with prepackaged sides and turkeys, and then your refrigerated semi-trailer behind the store that you used to keep them goes down, and you lose all of that money and all of that labor that it took. Tens upon tens of thousands of dollars of investment, of capital destruction, fighting entropy. So I was in this grind for years, and yes, it was very difficult. Eventually, Target started to reach out to me over LinkedIn. They tried to recruit me for a really long time. Eventually, I just said yes, and then I went to Target in the middle of the COVID pandemic, where I just saw that exact same thing, but we saw the supply chain fiasco that happened during COVID. So after COVID hits, we all know that the pallets just get stranded, the shelved resets get postponed because the working capital turns plummeted. Cash gets stuck in purgatory that we call in transit. Your shipments are stranded in the ocean from China, just waiting to show up one day magically somehow. And what happened was that obviously we had amazing performance during COVID, which was really just the result of liquidity, the stimulus checks entering the system, and people being able to just spend more money. So really, it's just fake growth on a more localized scale of the more broader economy. And Target is a Fortune 50 company, and I was in the Minneapolis area where HQ is, and I just dealt with very smart people, elite human capital. I'm telling you, very gifted individuals. We're actively working to solve problems, fighting the entropy every single day. So think the MBAs, the logistics wizards, anything that we can do to hold single-digit margins together. I was feeling it in my bones that I was just paying the hidden entropy tax every single day, and the tax rate only kept going up. And then if you didn't know, we had a really tough last few years after that liquidity just pumped our stock, pumped our performance. Well, we lost about $100 billion of market cap in a little over 2 years. I might be off by a year or some months or something, but the company went from something like 150 billion to 50 billion. Target's worth 1/3 of what it was in a very short amount of time. So you gotta think, as I am just stressed, pulling the hair out of my head every single day, and I discover Michael Saylor, the fact that he's using debt to buy Bitcoin, debt at 0% to buy Bitcoin, I really started to ask, what if Target diverted even 1% of all of their effort to make this work into looking at the balance sheet by stacking Bitcoin on the balance sheet? And that question cracked my door to the grand scheme of Bitcoin. The deeper I dug, the clearer it became. The safest balance sheet move wasn't another shrink task force. It was migrating all of that working capital into the only collateral that cannot leak, rot, or walk out the door. And then, of course, as I'm screaming about this on the inside, I just get people that look at me like I grew a second head, but whatever, it's fine. Sorry if I'm boring anybody with this story, but on top of just fighting the entropy, another thing that you have zero control over is the massive retail theft problem that we have. Every single year, you would conduct inventory of what is in your store on the floor and in the back rooms. It's literally measuring, okay, you did X amount of sales in a given year, let's say $100 million of sales. What percentage of those sales ends up as product that we cannot find? It's disappeared, it's gone. Now, those percentages obviously fluctuate on how well operationally any individual store is, but you would very regularly see 1% to 3% shortage. So if my store, for example, did $100 million of sales, in a given year, $3 million of product would just be missing. Flat out missing, it's gone. 3% gone. Anyway, it's just crazy. You should literally spend 1% of your time turning to the balance sheet to give your shareholders an outsized return. But what do I know? I've been a Bitcoiner for a long time, since 2011 or 2012. I don't remember which year exactly, but that was when I first bought Bitcoin on a software wallet in high school. It took me a while to become orange pilled entirely. Obviously, it's a process for everybody. But then I got sailor pilled, and for me, being sailor pilled wasn't really a long process at all because of these experiences that I had. I had pallets of pasta and toilet paper floating off Long Beach, while viral Instagram videos were showing empty shelves. Demand was off the charts, supply was off the coast. I was just living in the most risky environment possible. Craziness. And then as a broader part of society, you're seeing labor absenteeism spiking from 40 to 60%, which means that whole departments that you would manage would just vanish overnight. People are sick, they're scared, they're quarantined. Scheduling looked like a game of musical chairs, while half the chairs are suddenly on fire. Shoppers who would normally buy 3 items are now buying 30, and replenishment algorithms had no playbook for pandemic panic buying. You think of hundreds of millions of dollars of inventory just floating between somewhere in Shanghai. The CFO's dashboard shows record spends but no product to sell. Try paying payroll with goods stuck on a container ship. Maybe I'm diving too much into this, I'm sorry, but it is very important to me. I watched elite human capital, very intelligent people, elite operations directors, people from HQ, the logistics PhDs, the regional VPs, all burning themselves out, trying to defend single-digit margins, while literally millions just rolled out the back door. The operational fragility that Wall Street models just politely ignore was screaming in Dolby surround sound. So the epiphany, if a black swan supply shock can vaporize 2 years of earnings in 2 quarters, then the risk-free label on consumer staple equities is a fairy tale. Meanwhile, this whole thing was happening. Bitcoin just kept on time, 1 block every 10 minutes, no port delays, no strike votes, no shrink at all. The perfect storm didn't bend the blockchain at all. It exposed the rust in the traditional collateral. This was the freeze frame in the movie soundtrack that went silent, and the main character finally got it. Let's just say after 17 hours on a COVID inventory audit, if you run a back of receipt calculation, what if we diverted just 1% of our managerial bandwidth, 1 out of every 100 meetings, emails, and fire drills, into simply buying Bitcoin and cold storing it on the corporate balance sheet? The math just punches you in the throat. If you get extra 20 basis points of grocery margin, which might be your annual stretch goal, that would be maybe 400 grand on a $200 million P&L, but one time. The same human energy that could be redirected to stacking sats could place permanent, self-compounding collateral on the balance sheet. Even a single Bitcoin that was bought at $10,000 has already outperformed a decade of shrink reduction task forces. To every operating company out there, plugging operational leaks yields linear perishable gains, but stacking an absolute scarce bearer asset yields exponential persistent gains in perpetuity into the future. One is just a Sisyphean struggle where I'm pushing a boulder up the hill for eternity, and the other is sovereignty. In this moment, I just realized the safest corporate move was the one that every MBA textbook ignored. Just escape the entropy treadmill altogether. Once I realized this profound monetary system shift that we're going to live through, how risk is going to be repriced correctly over the next decade, over the next 20 years, however long it is, I decided to devote myself to the great cause of the Orange Gospel. All right, that's enough about me. If you guys want to know more, just let me know, but I really want to go into buybacks because they are capital destruction. Let's compare what you could have done in 2020 versus what Apple did. So here is the Apple's 2020 capital allocation, just total masterstroke. They torched $72.5 billion of buybacks, cash literally torn off the balance sheet, and incinerated just to shrink the share count. Wall Street cheers, CNBC calls it returning value. But at the average MicroStrategy 2020 cost of $15,964, that same pile would have bought 4.5 million Bitcoin. That's more than a third of the coins that are in the free float, enough to turn Cupertino into a sovereign monetary superpower overnight. If you fast forward to today's Bitcoin value, that stack explodes to $545 billion, 7.5 times the original outlay, and larger than Apple's entire decade-long buyback program altogether. The key insight, kids, is that buybacks aren't returning capital, they are a bonfire of optionality. Management is literally just confessing we have no higher conviction idea than bidding against our own shareholders. The one asymmetric, non-dilutive asset on Earth sat unloved at low 5 figures. Imagine the narrative shift if Apple would have said, we're parking 4.5 million BTC in the treasury to backstop every iPhone warranty on Earth. Their bond spread would collapse, their cash flow would torque to digital scarcity rather than their physical inventory, with all of that embedded risk. This is the reality if you are on a board today. Every board that approves a buyback without running the Bitcoin counterfactual internal rate of return is committing malpractice. A quick pivot to what the market might call a lot less risky than Bitcoin. Let's ignore the fact that DoorDash stock trades at 154x earnings. Let's ignore the fact that Costco is traded at 50x earnings. Let's talk about that investment into Tesla at the December 2020 peak at 941x earnings. If Tesla had started delivering their electric car the year that the Magna Carta was signed, shareholders would just now be breaking even. Why is that insane? Because the risk stack that is embedded in that investment isn't theoretical. There's lithium supply constraints, there's labor union pressure, there's geopolitical battery access, there's regulatory pivots, there's tech obsolescence, there's manufacturing complexity. But yeah, it's totally crazy to pay a 1.4 multiple for MSTR. Give me a break. Investors gladly price these industrial minefields as if they're risk-free annuities, while the same crowd calls Bitcoin speculative. We are living in the ultimate asymmetry, folks. At a heroic 20% EPS CAGR, yes, a 20% EPS CAGR, an investor still waits nearly 3 decades just to get their money back in cumulative earnings before discounting taxes or dilution. This 20% is double the long-run average of the entire S&P 500 and miles above any mature automaker in history, by the way. When investors are paying 941x to Tesla, I know that this is an extreme example, but they are underwriting 3 decades of flawless execution just to get back to par. When the same market prices Bitcoin or strategies prefs at speculative levels, they are ignoring that the earnings in the form of provable undiscounted collateral appreciating are already sitting on the balance sheet. Strategy already has the money. This video is probably getting a bit long, so I'm going to try to wrap it up. I mean, I could just make this a multi-episode series, but Strategy's Bitcoin-backed capital stack is literally just risk off in plain sight. I might save some of this content for another video because we are getting into the weeds here. It's fun weeds, it's good weeds, but hey, I don't want to repeat myself too much. I want to make sure I'm being efficient with my financial education. To finish, we do have a bunch of gears turning to prove that the market is somewhat waking up. There are some catalysts on the map that are already in motion. We have the FASB adoption. We're all on Twitter trying to make our own playbooks for how to value these Bitcoin companies. I think that you are going to start to see more accountability from boards. Hey, why don't we just buy Bitcoin? That is fundamental. It will happen. It has to eventually. This great risk inversion literally cannot survive just because people will find Bitcoin on a need-to-know basis. Thank you so much for watching. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video, subscribe to the channel. It would really mean a lot. Thank you so much. Have a terrific day. Do not party too hard. Once again, a special thanks to Horizon for sponsoring this video. Most people do not realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now there's a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual. Later, when you sell, refinance, or choose to settle early, Horizon's provider takes an agreed share of your home's future value, and that is the trade. Unlock cash now to stack Bitcoin by selling a slice of your home's future value while you just continue living in it. What makes Horizon stand out is that there are no term limits and you keep 100% of the Bitcoin upside. The Bitcoin is fully yours to custody however you want, wherever you want, with no risk of forced liquidation. If you've been sitting on a pile of home equity and are eager to invest in Bitcoin, this may be the product for you. Visit joinhorizon.com to see if you qualify and get started. Their team of experts will work with you one-on-one from start to finish. Transform your dormant home equity into Bitcoin today with Horizon.